Investing is, at its core, an act of comparison. We compare stocks, sectors, capital structures, time horizons, and ideas. But perhaps the most important and most often misunderstood comparison is between fundamentals and expectations. Great investors know that the market doesn't reward truth in isolation. It rewards truth that surprises. To spot those surprises, the best investors don't just look at facts. They look through lenses, multiple ones, and ask, what's priced in? What's typical? What really drives outcomes? This final essay in our 10-part series explores why elite investors view the world through a multiplicity of lenses: quantitative and qualitative, historical and forward-looking, analytical and psychological. We'll explore how multi-lens thinking separates deep insight from surface-level reaction, and how it helps navigate a world where prices reflect sentiment as much as substance. Legendary investor Michael Steinhardt called it a variant perception, a view that differs from the market's consensus and turns out to be right. To uncover this edge, investors must separate a company's fundamentals from the expectations embedded in its price. Consider NVIDIA in 2023. Riding the generative AI boom, its stock more than tripled in under 12 months. At first glance, the fundamentals were superb: record revenue growth, expanding margins, and dominant market share in GPUs. But great investors asked a deeper question. What growth rate, margin durability, and capex trajectory was already embedded in the price? Ascribing value is one thing. Understanding the valuation narrative the market is telling you is another. In horse racing, this distinction is intuitive. The odds represent expectations. The horse's condition, track record, and trainer are fundamentals. In equity markets, that logic often gets lost. When fundamentals improve, most investors instinctively want to buy. But if the price already assumes excellence, there's no edge. Great investors instead seek mismatches, where the horse is faster than the odds imply. Behavioral finance has shown that humans are adept at ranking preferences, but poor at assigning absolute value. We may not know what Moderna is worth in dollars, but we can say we prefer it to BioNTech because of its pipeline, leadership, or cash position. This phenomenon, called coherent arbitrariness, plagues comparative thinking in investing. Suppose you screen 10 biotech stocks by Analyst price target upside. This offers relative value. But unless you've built a fundamental model grounded in R&D burn, addressable market, and FDA approval probability, you may be misled. Moderna and BioNTech were once seen as twins, but their differing mRNA platforms, revenue concentration, and reinvestment strategies created divergence. Without anchoring comparisons in absolute value, investors risk mistaking price gaps for opportunity. Investors love analogies. Is this turnaround like Apple's in 1997 or like Nokia's in 2012? Is this IPO more like Google or Groupon? But analogies can mislead. They spotlight similarities and blind us to critical differences. Consider WeWork. Its charismatic founder, tech-style branding, and VC-fueled growth prompted many to compare it to Uber or Airbnb. But unlike those businesses, WeWork lacked network effects and asset-light economics. It was a real estate company with a software multiple. Compare that with Microsoft under Satya Nadella. Many were skeptical of yet another tech CEO promising culture change. But Nadella succeeded by shifting business lines, focusing on cloud infrastructure, and rethinking capital allocation. His playbook bore little resemblance to flashier tech turnarounds, and that's exactly why it worked. Great investors supplement analogy with statistical base rates. Rather than asking, does this feel like X? They ask, what's the typical outcome for cases like this? That's where insight lives. Amos Tversky famously showed that people's assessments of similarity and difference are influenced by framing. In his study, most respondents said East and West Germany were more similar than Sri Lanka and Nepal. But when asked which were more different, the same respondents again picked East and West Germany. Logically incoherent? Yes, but also very human. Investors fall into the same trap. Compared to ESG funds. Focus on returns and they might seem identical. Focus on carbon exposure or shareholder engagement and they diverge. Frame the comparison financially and you'll rank them one way. Frame it socially and your ranking may flip. That's why great investors triangulate. They reframe. They ask not just, is this a good investment? But under what lens is it good? And what might I be missing? Another trap in comparative thinking is confusing categorization with causation. Just because two stocks are pandemic beneficiaries doesn't mean their futures are intertwined. Zoom and Peloton both surged during COVID. But Zoom offered a lightweight, enterprise-embedded service with global network effects. Peloton sold expensive hardware with low upgrade frequency and rising customer acquisition costs. Attributes were similar. Circumstances and causal drivers were not. Investors who saw both stocks as remote economy plays got burned. Those who analyzed why each business was succeeding, what was durable and what was not, made better decisions. Great investors don't just compare within categories. They import lenses from other domains: biology, where systems evolve; engineering, where redundancy prevents failure; psychology, where narratives drive decisions; and statistics, where base rates reveal what anecdote conceals. Tesla is a perfect example. Is it a car company? A software platform? A battery producer? A clean energy firm? The answer depends on your lens. And it determines your valuation approach, risk framework, and competitive analysis. The mosaic theory of investing encourages this cross-disciplinary lensing. Rather than relying on a single model, great analysts assemble fragments from science, sociology, business, and markets into a fuller picture. So how does an investor actually embed this comparative discipline into their daily process? It begins with making the implicit explicit, drawing out the assumptions that sit beneath prices and challenging them systematically. One of the most powerful tools for doing this is the reverse DCF. Rather than starting with a valuation and asking what a company is worth, the reverse DCF flips the question. Given the current share price, what assumptions about revenue growth, margins, and reinvestment are already embedded in the valuation? By extracting the market's expectations directly from the price, you create a benchmark to compare against your own view of fundamentals. Another important discipline is the use of base rates. This means stepping back from the specifics of a single case and looking at the broader statistical outcomes across a relevant reference class. If you're analyzing a retail turnaround, for example, it helps to ask, on average, how long does it take for such businesses to recover? What percentage of them actually succeed? The same logic applies to platform roll-ups in sectors like healthcare. What does history say about their success rate, margin stability, or long-term return profiles? Equally important is the way we use analogies. Investors naturally reach for comparison. This company reminds me of that one. But analogies should not go unchallenged. Make it a habit to list out what's similar, what's different, and, perhaps most critically, what's missing. Surface similarities can mask deep structural differences, and it's often in those differences that investment theses are made or broken. Finally, it pays to reframe comparisons deliberately. Look at the same investment through different lenses. A valuation lens might tell you one story, while a customer lens or a macroeconomic lens might reveal another. A company might seem overvalued based on traditional multiples, but indispensable when seen from the perspective of user dependency or macro resilience. This triangulation across frames creates a richer, more resilient investment perspective. There are risks to multi-lens investing. Time constraints, especially in active management, can limit how many angles you can explore. Too much modeling can lead to analysis paralysis, where conviction dies in complexity. And not every lens adds value. Some distort more than they reveal. The solution isn't more complexity. It's disciplined plurality, knowing which lenses to use, when to use them, and how to synthesize their insights. The final habit of great investors is the most philosophical. They view the world through multiple lenses, not to impress others, but to understand better, not to complicate, but to clarify. They are skeptical of easy comparisons, aware of human biases, and relentless in triangulating toward truth. In doing so, they not only see the world more clearly, they see themselves more clearly too. And in that reflection lies their greatest edge.